Welcome to O-Levels Business Studies Unit 4, Types of Business Organization. Let's dive in. We begin with the simplest form of business, the sole trader. A sole trader is a business owned and operated by one individual. It's the most common form of business organization due to its ease of setup and minimal legal requirements. For instance, the owner only needs to register with the tax office and, in some countries, register the business name. Sole traders enjoy complete control over their business decisions. They keep all the profits after taxes and enjoy confidentiality in business operations. However, this independence comes with significant risks. Sole traders face unlimited liability, meaning they're personally responsible for all debts. Additionally, raising capital can be challenging, and the business lacks continuity if the owner retires or passes away. Next, let's talk about partnerships. A partnership involves two or more individuals sharing ownership of a business. This structure allows partners to pool resources, skills, and capital. Partnerships are relatively easy to set up and offer shared responsibilities, which can make managing the business less overwhelming. However, partnerships also have unlimited liability, meaning all partners are responsible for the business's debts. Disagreements between partners can also lead to inefficiency. Partnerships rely heavily on trust and good communication between partners to succeed. A limited liability partnership, LLP, offers limited liability, protecting partners' personal assets. It's a separate legal entity, continues after a partner's death, but shares cannot be bought or sold, ensuring close control. Private limited companies are a step up in complexity. These are incorporated businesses, meaning they have a separate legal identity from their owners. This distinction provides limited liability, so shareholders are only liable up to the amount they invested. Private limited companies can raise capital by selling shares, but these shares cannot be sold publicly. While this structure offers more security and opportunities for growth, it comes with challenges. Legal formalities, such as creating a memorandum of association and articles of association, are mandatory. Additionally, financial accounts must be publicly disclosed, reducing privacy. For larger businesses aiming for substantial growth, public limited companies are the ideal choice. These companies can sell shares to the public, often through stock exchanges, to raise significant amounts of capital. Public limited companies enjoy continuity and limited liability, making them attractive to investors. However, going public isn't easy. It involves complex legal procedures, public disclosure of accounts, and the risk of losing control to external shareholders. There's also a potential conflict between ownership and control, as shareholders own the company, but directors and managers make the decisions. Now let's look at franchising. A franchise is a unique business model where a franchisor allows a franchisee to operate under its brand name. This model benefits both parties. Franchisees gain access to an established brand, training, and reduced business risk. Meanwhile, franchisors can expand their business with minimal investment. However, franchising has its downsides. Franchisees must adhere to strict franchisor guidelines, which can limit their independence. Additionally, a poorly performing franchisee can harm the reputation of the entire brand. A joint venture is a collaborative business effort between two or more companies. This structure is particularly useful for large, resource-intensive projects. Partners share costs, risks, and expertise, often resulting in a successful outcome. Despite these advantages, joint ventures can face challenges such as disagreements between partners and cultural or operational differences. Clear communication and aligned objectives are essential for success. They also have to share profits. Now, let's discuss public corporations, which are owned and controlled by the government. These organizations often provide essential services like water, electricity, and public transport. Public corporations ensure that vital services are available to everyone, even in unprofitable industries. They also help maintain employment in struggling sectors. However, public corporations face criticism for inefficiencies due to a lack of competition and profit motives. Political interference can also lead to decisions driven by short-term goals rather than long-term sustainability. Lastly, other public sector enterprises are operated by local governments, often for services like libraries, swimming pools, and street markets, and they aim to balance costs and public benefit, sometimes requiring subsidies to operate efficiently. Thank you for watching. If you found this video helpful, don't forget to like, share, and subscribe. See you in the next video.